So let us look at August 2023. Question number 5B. This is what we are told. Mapato Limited has the following capital structure which it considers optimal. You are given the debentures 25%, preference share capital 15%, ordinary share capital 60%. Additional information: Mapato Limited expected profit after tax for the year ended 30th June 2023 was shillings 34,285,714. Mapato Limited has an established dividend payout ratio of 30%. The tax rate for the company is 30%, and investors expect earnings and dividend to grow at a constant rate of 9% per annum in the future. The company paid a dividend of shillings 3.6 per share in the year ended 30th June 2023. The company's shares currently sells at shilling 60 per share. The company can obtain the new capital as follows. Ordinary shares. New ordinary share capital can be issued at a flotation cost of 10%. Then preference share capital. New preference share capital can be issued to the public at shillings 100 per share. The flotation cost is shillings 5 per share and a dividend of shillings 11 per share. Debentures. Debentures can be issued at an interest rate of 12% per annum. Number 4, assume that the cost of capital is constant beyond the retained earnings breakpoint. And number 5, Mapato Limited has the following investment opportunity. You are given the project cost and also you are given internal rate of return. Required: calculate the breakpoint in the marginal cost of capital schedule. So the first requirement, the examiner wants us to calculate the breakpoint. So how are we going to get the breakpoint? Is very easy. Is the amount raised, then you divide by what? You divide by the weight or proportion in the capital structure. Weight or proportion in the capital structure. So in this case, let us first get the retained earnings. Retained earnings, how do we get the retained earnings? It's very easy. It's the profit after tax, then you multiply by the retention ratio. So the profit after tax, we are given how much? It is 34 million, then 285,000, and then 714. Then we multiply by the retention ratio. So in this case, the examiner has given us the payout ratio, which is 30%. Therefore, our retention ratio will be 100 minus what? Payout ratio. So it is 100 minus 30, which will be 70%. So our retained earnings will be how much in this case? Our retained earnings will be 34, 285, then 714 times 70%. So in this case, we are getting 24 million. This is 24 million. That is what we have, 24 million. Then let us get our breakpoint then. Our breakpoint will be, the amount raised is 24 million. 24 million, then you divide by the weight or proportion. The weight, remember we have the weight of debentures, weight of preference, and ordinary share capital, or what we call the weight of equity. The weight of equity in this case is 0.6. So therefore, our breakpoint will be how many shillings? Our breakpoint in this case will be how many shillings? Let's see. It is going to be 40 million. Our breakpoint will be 40 million. That's how you are supposed to compute the breakpoint. If we had the breakpoint of ordinary loan again, we should have taken the amount raised, then we divide by the proportion of the debt. Then once you have established that, that's Roman 1, then Roman 2. We go to Roman 2. Roman 2, the examiner wanted to determine the cost of capital structure. They wanted the cost of capital structure component. Capital structure components. Capital structure components. And the capital structure component, so number 1, we are going to start with the cost of retained earnings. So how do we get the cost of retained earnings? In this case, it's given by the DO. Then from there, we have 1 plus G. Then we divide by PO. Then because this is internally generated funds, we don't have the flotation cost. Then we add G, and then everything you multiply by what? By 100. So the dividend, DO present the dividend per share. The current dividend paid, 3.6. 1 plus, it is growing at which rate? 9%. So 0.09. Then all over, the PO is the same as the current MPS. So our current MPS is how much? We are told is 60. Then we add 0.09. And everything we multiply by what? We multiply by 100. So how much are we getting? The first component. The first component will be how much? It is 3.6 times 1.09. Then from there, we will divide by 60. Then plus 0.09. Then you multiply by 100. So you will get 15.54. So here is 15.54%. Then we go to the second component. The second component is the cost of ordinary shares. How do we get the cost of ordinary shares? We just copy paste. So it is the DO 1 plus G. Then all over PO, but now you raise what? Additional cost, or what we call the flotation cost, or sometimes we call it the issue cost. So here it will be 3.6, then 1 plus 0.09, then from there you divide by what? You divide by 60, then you add, in this case, then you raise the flotation, it is 60 times 10%. Then you add 0.09, and everything you multiply by what? By 100. So how much are you gonna get in that case? So in this case, it will be how much? Let us see. 3.6. So it will be 16. This is 16.27%. That is the second component. Then we go to the third component. So the third component, we are going to talk about what? The debentures. So let us get the KD. And in this case, you can see our debentures. What the examiner has given us is only the interest. So it will be the interest into bracket 1 minus T. So 1 minus T, let us get that. So the interest is how much? Note number 3. The last bit they are talking about 12%. 1 minus the tax rate. We are given 0.3. So in this case, the debentures will be how much? The debentures will be how much? It is 12 times 8.4%. This is 8.4%. Then we go to Roman 4. Roman 4, in this case, we get what? The cost of preference. The cost of preference, we normally talk about the dividend. It is the dividend, preference dividend, then you divide by what? The market value of what? Of the preference, then you multiply by 100. If we have the flotation cost, again we take note of the flotation cost. So the dividend were how much? You are told note number 3, new preference share capital can be issued to the public at shillings 100 per share. Flotation cost is 5 and dividend is 11. So 11 all over here 100 minus 5. That is what we are told. Then times what? 100. So therefore, how much are you getting in this case? So it will be 11 divided by 95. Then you multiply by 100. So you will get 11.58%. So this is 11.58%. So those are the components. Those are the capital structure components. We have the retained earnings, then we have the ordinary share capital, then cost of debt, and also we have the cost of preference shares. After computing that, Roman 3, the examiner wants to calculate the weighted average cost of capital, WACC, in the intervals between the breakpoint in the marginal cost of capital. So they want us to calculate what? The WACC. So here we are going to have the range. We just talk about the range. So we are talking about Roman 3. So we have the range. Then from the range we have the breakpoint. And then the breakpoint we will take WE, KE. This is the weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, cost of debt, then 1 minus T will give us what? WACC, what the examiner wants. So this is how we are going to compute it, the way the examiner wants. So the first range will be 0 to 40 million, 0 to 40 million. And when we take about 0 to 40 million, that's the first breakpoint. Our weight of equity, we know the weight from the optimal capital structure given. The weight of equity is 0.6 times the cost of equity. We are going to use the cheapest, and in our case is the retained earnings, which is 15.54, plus weight of preference, 15%, 0.15, cost of preference 11.58, then plus weight of debt is 0.25 times the cost of debt is how much? 8.4. So therefore, in this case, we will get which percentage? Which percentage in this case? Let us see which percentage we are getting in this case. 0.6. So in this case, we are getting 13 point. We will get 13.16%. Then we have the next will be above 40 million, not 40,000. Sorry, it should be 40 million. So above 40 million. Above 40 million is our second breakpoint. Remember, we have exhausted the retained earnings. So we go to the next one, and under equity, the next one is what? Is the cost of ordinary shares, which is 16.25%. to 7. For the preference, it is unlimited, it is going to remain the same. And also for the debt, it is unlimited, meaning it will remain the same. So which percentage again are we getting in this case? So we'll get 13. It is 13.60%. That is what we have. Those are the WACC within the ranges that we have. Then next one is we go to Roman 4. Let us see what the examiner wants in Roman 4. Roman 4, you are told that using the marginal cost of capital schedule, identify the project that the company should accept and why. So in this case, we need to come up with a table, and our table will have the project, then from the project we have the cost, then we can have accumulated cost, and then we can talk about the WACC, and then we have internal rate of return. This is the table we need to have. We need to have our table in this case. So once we have our table, in that case, we need to confirm whether the project's IRR is in a descending order, from the highest to the lowest. If it is not, the first step is for us to arrange and ensure that our internal rate of return is in a descending order, from the highest to the lowest. And if you can confirm, in this case they are. So our shillings can be in thousands, our shillings can be in thousand here. So therefore, we start with project A, B, C, D, and E. That's what we have. Here can be 10,000. Here we have 20,000. Then here 10,000. Then next one is 20,000. Then 10,000. Then here 10,000. Then 30,000. 40,000. 60,000. and 70,000. That's what we have. So remember our ranges here. We have our ranges here from 0 to 40. From 0 to 40, our WACC will be 13.16, and up to here it will be 13.16%, 13.16%, and 13.16%. Then we are told above 40, our WACC will be how much? It will be 13.60%, 13.60%. Then our IRR was, it was 17.4%. Then we have 16.0%. Then 14.2%. Then we have 13.7%. And also we have 12.0%. That is what we have. Then from there, once we have put that down, let us see what we call the decision criteria. Decision criteria, we normally say if WACC or WMCC is greater than what? Is greater than IRR. Is greater than IRR. In this case, you do what? You reject the project if our WACC or WMCC is less than IRR, you accept the project. You accept the project. And if they are the same, if this stroke this one is the same as IRR, we normally talk about what? Point of indifference. Point of indifference. Point of indifference. So therefore, let us go back to our question, and now let us make the comment here. Our comment here, the first case will be, you need to accept the project because our WACC is less than the IRR. Also, in this case, you do what? You accept the project. Also, we have this one is less than this one, so you accept. And also, we have this one, which is less than this one, so you accept the project. And finally, you do what? You reject the project. Those are the decision criteria, and that's how the examiner wanted us to compute this question for us to get the 16 marks. This is how you are supposed to get, sorry, not 16 marks, but 14 marks in this case. It is as easy as this. As far as you understand the formulas and you understand the question, you can compute it very easily.